Commercial real estate is a game of revenue and the investor's willingness to buy these properties, the demand for these properties. So it is not what you like. It is not what you're used to. It is not what you want to live in or rent. It's typically, we look at it from a pure, is this a good market? Is this a good location? Is this going to drive investors' interest and tenant interest? And the revenue position. What is the revenue? Because ultimately the value of a commercial real estate property is revenue and multiples. What is that cap rate that will dictate, what we look at? So when you look at multifamily, typically you're probably going to look at your age and what you like, and maybe you're going to be in a class A or A minus or B plus. This is something that you would rent and you would love to live there. And those properties are not bad, but that's not how we look at it. So take the emotion aside, take your own perception of what would you live in or rent as a tenant, and apply what the industry is looking for and what's going to make us and our investors money.
So you mentioned what you and your investors look for. Can you elaborate on maybe a few of those points? 2, 3 of the points, 2, 3 of the major key indicators for what makes a property a good property, and we'll talk specifically about the multifamily.
Actually, we should start not talking about only multifamily. I know we're a multifamily shop, but most of the next 2 years or 3 years of our investments are going to be something else. And we already branched into the niche development and niche acquisition outside of multifamily, because as we explained in previous videos, multifamily is on hold. Unless we find a really cool deal, we're not really looking to buy multifamily this year, probably not early next year as well. What I like to say, commercial real estate is local. And local geographically, so I can't say general statements around Houston, for example. Southeast Houston is different than Northeast Houston, is different than the Woodlands, is different than Sugar Land, is different than the outskirts of the city. So commercial real estate is local. So when we look at location, we look at very specific location. Growth higher than the national average is what we look for. And when we say growth, it can be population growth or income growth. So we look for demographics, we look for demand, we look for areas and zip codes that are growing above the national average, preferably double digit. When you apply that to Houston, it's basically, we follow the Grant Parkway. So north into northwest, into west, into southwest is what we like in Houston. It doesn't mean that you can't find good properties on the east side. That's our market that we focus on. When it comes to Dallas, we love the north. We have a project in Melissa, and we love that growth that is happening on the 75 corridor. Oklahoma City, also north, northwest into west, between Mend and Yukon and the Kilpatrick Highway. So that's one, location. Everything starts with location. But within the location, we look at specific demographics. You can look at a Class A apartment. It's a nice, good-looking apartment, but it might yield the least returns. It is a steady state, typically a strong building with strong tenants, but it may not yield a lot of return for our investors. There's not an opportunity to increase a rent as well. Sometimes you introduce technology, but most of the new units now are technology infused. We add more services, valet trash, grocery delivery, yoga classes, and electric charging for the cars. But overall, our maneuverability and value add as an investor is very low when it comes to nice Class A buildings. Historically, Class C, the blue-collar apartments for our everyday workers has been great, but right now it's just too risky to have a lot of these properties under management. So we like the middle of the road, which we call Class B. Class B is any apartment that was built mid to late 80s into the early 90s, where it's not too old, but it's not new. And this gives us the ability to create value-add programs, renovate the units, increase the amenities, add more activities to the tenants, and allow us ultimately to charge for these services and higher standard of living, which is how we make our investors money. So the higher the revenue from that property, the better the valuation for us. So this is multifamily, for example. When we look at medical offices, we like to be in the suburbs, away from the central business district, the inner city, we like to go with the growth. So again, the same formula for the locations, but we like to follow the rooftops. The fundamentals for medical office are different. So we like to be in the suburb where the growth is close to hospitals, anchored to hospitals. So when you're like, an investor and you want to look at a medical office, it doesn't need to be the prettiest all glass building, for example. We need to look at who the tenants are, how strong are the tenants, how long are the contracts, and is it anchored or not by a hospital. So a lot of our criteria is specific to the location, but it's also specific to the asset class. And it's not the shiniest object, it's not the most visible, and it's not what you think normally you would live in or rent as a tenant. Obviously, there's some truth to that, nicer properties, maybe less risky, maybe in a better area with less crime, with more access and visibility. But again, I would say that with putting your emotions aside when you make an investment decision. We developed a criteria for every asset class when it comes to acquisition. So medical has a criteria, suburban office has a criteria, multifamily has a criteria. Even within multifamily, built to rent townhomes has a criteria for startup families. Senior housing has a criteria. We do industrial as well. And within industrial, we have light industrial. We'll focus on flex space. That has a criteria. And finally, medical offices. So you think about each asset class and sub-asset class has a criteria. Within each city has a different context. And that's kind of how we look at it. Ultimately, when we kind of check the boxes, the location is good and the asset class and the property we're about to develop or buy and manage meet those criteria, this is when we actually dig deeper into, okay, how we're going to make money in this project. The main thing is there a story? An owner story or a property story? If there's no story and it's listed and there's like 1,000 investors are going to bid on it, our likelihood of acquiring that property is going to be low. So what we look for there is like, what is the motive for the seller to sell? What value can we add to the property? Is there a program that we can implement that people may not see that will allow us to increase rent, reduce cost, maybe add more additional rent by providing more amenities and activity? So we don't look at the property as, okay, we're going to buy it and hold it. So the first thing is a story. Is there a story by the owner? Did they make their money on the property and they want to exit? Did they inherit the property? Is there a problem with the owner's financial position? Is there maybe a problem in the partnerships that own that building? What is the story? Is there a story on the owner? But the second thing is, what is the story on the building? Can we push the rent? Can we create a value add program? Can we develop something niche in this area that requires a new structure that we develop and make money from ground up construction? So that's the first thing. So a lot of people may look at the same property and not translate that value add and maybe offer a very low offer on the property, which will not make him win it. But when we see an opportunity, we'll go ahead and offer something that makes sense for us, that makes our offer more competitive. So that's one way we look at hidden gems. Another hidden gem can be, maybe the previous owner did not take care of the property. So that's a pure physical, we're gonna actually go and renovate the building and take it to the next level. And guess what? That older building sits in a nicer area. So that's another criteria we look at. We like the area to be cleaner than the property, so we can bring that property up to that level. So like if we have an older property in Memorial in Houston or an older property in the Galleria area, well, that area is already a nice area. And now if you renovate, you can make that property match the area and command a higher rent and a nicer lifestyle.
Can you share a quick story or an example of a property that surprised you?
The main thing about surprises, I think there's a couple. One is our very first property. We had done our due diligence on the physical, inspections, making sure that everything is how it was presented. And then we looked at all the financials and all the contracts for the tenants, and we made our assumptions on the revenue position and the cash collection position. Come to discover on day one that some of these numbers were not accurate, and we couldn't discover that in the due diligence process. So That made us start in a much lower position from a cash collection. Although we had almost 100% occupancy, we discovered that a good portion of our tenants were not paying rent. So that forced us into an eviction process and a delayed revenue for that property.